Hey everyone. SoFi stock price is underperforming the wider stock market index year to date. In fact, SoFi stock price is down to $7.07 per share after starting the year closer to $10 per share. So why is SoFi stock price falling, and is it a buying opportunity? I'll answer both of those questions in this video, so let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as I noted, you can see SoFi stock price performance year to date in 2024, down from a little over $9.60 per share to its current share price of $7.07 per share. So the stock price is down roughly 30% year to date, when the broader market indexes are up double digits year to date. So a significant performance for SoFi stock in 2024. Of course, I've had SoFi stock rated as a buy ever since May 13th, 2024, and perhaps even before then. This is when I last updated SoFi stock and reiterated my buy recommendation for SoFi stock. But in this video, I'll update and I'll let you know if I still think SoFi stock is a buy. But first, let's address the reason why SoFi stock price is falling. So the number one reason why I think SoFi stock price is falling is because of a rising delinquency rate for credit cards in all commercial loans, not just credit cards, but all commercial loans. The default rate you can see here on the bottom right hand side has been steadily rising and is now up to a rate of 3.16% in Q1 of 2024. Now this delinquency rate is the highest it's been going all the way back, you can see, to Q4 2011. So this is way higher than it was during the years before the outbreak. These default rates were hovering around 2.5%, and before then they were around the low 2% range. Now they're up over 3% and they are heading higher. To make matters worse, consumer credit card balances are higher than they've ever been. You can see here consumer credit card balances here in the fourth quarter of 2023 at $911 billion total large bank consumer credit card balances. Now this is higher than it's ever been, going all the way back, and you can go several years. Now these numbers are not inflation adjusted, so if you adjust them for inflation, they will still be near record highs, but the difference won't be as dramatic. But you can see here consumer credit card balances have exploded and they're getting out of control. On top of that, yes, the unemployment in the economy is near record lows here at roughly 4% unemployment rate, but this number too has steadily been moving higher from lows of around 3.4% in April 2023 all the way up to 4% now in May 2024, and it's been trending higher ever since the Federal Reserve increased interest rates. This trend moves higher, and when it's trending like this in an upward direction, it typically, you can see here in the past, continues rising until we have an economic recession. The areas shaded in gray here are recessions. So the worry is that credit card balances are rising, default rates are rising, people are losing jobs at an increasing rate, and so that's going to further make matters worse in terms of defaults, because when you lose your job, you're more likely to default on your debt. Okay, so why does all of this matter for SoFi? Why is this hurting SoFi stock? Well, let me share that with you next. So SoFi stock has significant sums of debt outstanding. So it's a bank, right? It lends money, it takes deposits, and as of right now, total fair value of loans on its balance sheet were $21.95 billion. And the vast majority of the loans on the balance sheet, $14.332 billion out of the $21 billion, are personal loans. The unpaid principal balance on its personal loans are $14.3 billion out of the $21 billion. And those are the ones where people are most likely to default on first. When you lose your job, your home loan is the last thing that you're going to default on. So that's the more secure lending that's collateralized. So if a person defaults, the bank can go and foreclose on the home and take over the home and regain some of the money that it lent. But these personal loans, SoFi is unlikely to recoup any of this when folks default. And so investors are concerned that as default rates are rising, as people are losing their jobs and credit card balances are getting stretched, people are going to default on these personal loans at an increasing rate. As of right now, SoFi says their weighted average annual default rate on personal loans is 4.8%. 4.8% higher than the delinquency rate right now. For all loans, it's at 3.16%. I shared with you that. So personal loans are already defaulting at a higher than usual rate, and investors are concerned that these personal loan default rates will accelerate. You can see student loans only 0.6% default rate. These are relatively safer because people cannot discharge these during bankruptcy. So these are the reasons investors are concerned. SoFi has $14.3 billion in unpaid principal personal loans, and that's the vast majority of its business. Now, SoFi realizes these risks. Remember, coming into the year, SoFi management said that they're going to decrease lending by 5 to 8% because they realized these trends were getting worse. So management has been prudent. Already, they've decreased the outstanding balance of personal loans. From December 31st to March 31st, you can see the balance has fell, although slightly, from $14.49 billion down to $14.3 billion. And this while they've increased lending on student loans. So they're increasing lending on student loans, but decreasing the balances in personal loans. So management is aware. Management is taking steps to account for what they see as a rising default rate, as a more stretched consumer that's facing more difficult economic situations than they were last year and the year before that, when their balance sheets were stimulated with economic stimulus checks and unemployment benefits and other forms of support from the government. So all of that is what's causing SoFi stock to underperform the broader market despite excellent growth numbers in terms of their revenue, their profits, their cash flow, their increase in accounts, their customer acquisition, customer engagement, all of which are working well. But then you see the stock price falling, so you may have been unaware of why this is happening. So this is the main reason, right? SoFi is a bank. The vast majority of its revenue and its risk comes from the banking side of the business. Even though it's trying to diversify and become more of a tech player, it's still highly exposed, just like a bank, to lending products, and even more so because a higher percentage of its loans are of the riskier type. Now, I will say that SoFi has been very prudent with its lending. It's going after customers with a very high credit score. In the 750s is around the average credit score for SoFi lending products and SoFi customers. But SoFi customers tend to skew at a younger age group, and some of those numbers for, how reliable is a credit score of 750 if the individual is just 21 years old? There isn't enough history there to have confidence in that credit score, even though that person may have had 3 years of excellent credit history with paybacks and very high income. Still, with only 3 years of credit history and without going through a recession, how confident can you be that this individual has managed their finances prudently? So there's the risk. Even though I've fully acknowledged all of these risks and I've held SoFi stock as a buy throughout these last few months, because I felt that the potential rewards for investing in SoFi stock, analysts on Wall Street expect its earnings per share to grow by 51% each year over the next 5 years, and management has also been bullish on their earnings per share outlook. So I've felt that the rewards for investing in SoFi stock outweigh the risk at its current valuation at a forward PE of 32.51. So those are the risks associated with SoFi stock right now, and they're all legitimate, right? I shared with you the rising delinquency rate, high credit card balances, a consumer that's getting stretched, But still, even acknowledging those risks, I think the rewards for investing in SoFi stock outweigh those risks. So I'm saying that SoFi stock is still a buy, and I'm updating that recommendation on June 12th. But remember, everyone, these risks are rising. Still, the risk versus reward is in favor of investors right now for SoFi stock. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.